Well, good afternoon, everyone. This is Steve Bruno, Chief Investment Officer here at 12 Points, welcoming you and appreciate your time this afternoon. I am joined by Dan Cole, who is a partner at Quantix Commodities out of Greenwich, Connecticut. I've known the Quantix guys for a number of years now. We are investors in one of their flagship ETFs with the symbol HGER, which we affectionately refer to as Hedger. And as I was saying to Dan a few minutes ago, one of the reasons why I had asked Dan and his team to join us on this year-end call is because as much as 2025 has been a year of a lot of equity volatility, there's been a lot going on in the commodity markets as well. And although I am an equity guy for the last 40 years, I just don't think the commodity guys get enough love. So this is my opportunity to open up the floor to Dan and the wonderful work that his team does, and to look at both the year 2025 from a broad perspective, a global economic perspective, how the commodity markets have behaved during that, and look at 2026 and beyond through that lens, because I think it's very important to apply the diversification that we do here at 12 Points that goes well beyond the equity and the fixed income markets. So that is backdrop. I'll turn over the presentation to Dan, give a little of his background, his team, and his outlook. Dan?
Perfect. Thanks, Steve. We very much appreciate the opportunity to speak to everybody today. It's always nice to get a bit of love, and certainly the last few years, commodities has been a much more topical place for people to discuss than in the 2010s, when, frankly speaking, nobody wanted to talk to us. It wasn't an important part of people's portfolios. Most people got out of it. But today I can measure the popularity of. I was joking with Steve beforehand. I can measure the popularity of commodities by the number of texts I get about the conspiracy theories about silver and JP Morgan and all sorts of the other sort of heroes and villains in the commodities world, because people read the world for sale and always want to know sort of what's going on in the market, because it's such an intuitively attractive market for investors and for sort of everyday people. Largely because we are, it's consumed by people. It's food. It's the metals that go into people's cars and the electricity grids. It sort of touches people's lives in every day. So from that perspective, thank you again, Stephen and the team for inviting us. Quantix is a $4.5 billion commodities asset manager. We are headquarters in Greenwich, Connecticut, as Steve mentioned. And the DNA of the firm, and basically most people who worked here all came from Goldman Sachs. So for better or for worse, that gives us a certain view of the world and also an expertise in commodities investing. I think if you read the history books, the mortgage guys got all the glory in 2008 for Goldman's financial earnings, but let me tell you, the commodity desk was not far behind them in terms of P&L generation. And at Quantix, some of my fellow partners are the teams that ran those desks, and then ultimately sort of ended up running parts of the commodities division for Goldman. So I think a deep history and expertise in the markets, which we believe you need, because they just look and feel differently to equities or to bonds or to other financialized assets. They're not driven really primarily by the Fed and by sort of global liquidity. They're primarily driven by supply and demand and expectations thereof. Gold is slightly different, and we'll come on to talk about that much more later. But certainly commodities as a whole is something where we view has been unfairly sort of maligned by people's investment opportunities and the available products over the last 25 years. And we think it should play a much more important part in people's portfolios. And my job over the next half an hour is to let you know a little bit about our outlook, what's happened this year, both broadly and in commodity markets particularly, what our outlook is both broadly and in commodity markets in particular as well. Steve, I don't know if we can answer questions, but if we can, then obviously happy to take them on the way through or at the end.
Yeah, no, Dan, that's a good point. I forgot to remind everyone. I'm all set in terms of I have a monitor here that will display any questions that we have, and we certainly can leave some time at the end as questions come across. I can read them aloud, Dan, and just you and I together can probably answer them.
Okay, perfect. Yeah, we're having so much fun beforehand, Steve. We forgot to discuss it. So let's kick off and sort of talk about that's a picture of a good-looking Steve, and that's a picture of a little bit of a younger me. But let's sort of dive into what has happened so far this year. And I think nothing about this will probably be a surprise to people. And in a minute, I'll zoom out a little bit over the last few years. But I think obviously the story of this year for financial markets has really been a sort of tale of two halves. I think certainly the first couple of months of the year, that this is over the last 12 months, but if you look sort of through January, February of this year, equity markets treading water because of the incoming US administration and sort of some of the uncertainty around the policies that they would pursue. You had sort of, as those policies came to the fore in March, and some of the uncertainty went away, but sort of the market got a first look at some of the potential tariff policies and the like. And then obviously, the Rose Garden announcement in April was sort of the big move at the beginning of April, as Trump sort of upended the global trade agreements and sort of either threatened or placed tariffs on basically every country in the world, using them as a weapon to achieve his economic aims. And then I think maybe not to the surprise of everybody on this call, but certainly to some of us, so I'm just getting some messages saying to exit a couple of things, but certainly to some of us, I think the rebound in the equity market probably caught a few people by surprise when you look at some of the hedge fund data or some of the participation data. I think generally the retail crowd did pretty well, but certainly the institutions were under allocated to equities for most of that portion. And then for the last 6 months, we've sort of had the AI mania trade and sort of the rally in the second half of the year, really only uninterrupted sort of in November, when we saw obviously the sell-off in the crypto space being more correlated with the NASDAQ than ever before, and also some concerns about potential Fed policy, and which I think the uncertainty there is just higher than ever, even after the rate cut we saw yesterday. So broadly speaking, that's sort of the story of the year. It's not a surprise to people. I put the S&P 500 in here in orange. It's up 14%. If you look at the NASDAQ index, it's up sort of 21%. That's the yellow line. Both of those including dividends reinvested, because I'm being fair. But ultimately, a pretty decent year for the stock market, albeit one, as Steve mentioned earlier, with a huge amount of volatility. Now, I didn't include any international indices on here, but I'm sure everybody knows that actually the international indices, for the first time in many years, have outperformed the US. The MSCI World is up sort of mid-20s, depending on whether you look at the US dollar hedge version or the local currency version. But certainly that is a product of things, but including some of Trump's policies. So, for example, NATO is committed now to spending 5% of their GDP on defense, and that's given a huge boost to certain manufacturing industries in Europe, in Germany in particular. And so that has driven this sort of move or this move higher within the international equity markets. What I find fascinating and what we spend a lot of time talking to clients about is whether sort of this uncertainty in the US around tariffs and others, even as we've gone through the year and the tariff announcements have been rolled back, some of that deep uncertainty from April is gone, but that sort of surface level uncertainty I think is still around. Whether that signifies the end of US exceptionalism, signifies the end of King dollar, and sort of those bigger questions which were very at the forefront of financial markets in sort of the second quarter of this year have sort of largely died down a little bit, and it's amazing what positive equity market performance will do as everybody sort of switch focus from that to the AI trade. I think now there's a lot of focus on the Fed policy and sort of the path of interest rates in the US, but I do think those question marks around the US are still simmering, and the US's place in the world simmering sort of slightly below the surface, and whether US assets will continue to outperform as they have for a very long time. So that's sort of broadly speaking the equity market. Global GDP sort of has been okay. It depends on sort of where you look. The US definitely has outperformed the rest of the world in that. Certainly where I'm from, the UK has been mild this year, as has sort of Germany and some of Europe, with some pretty low growth environments. So the US and the US consumer, sort of the 2/3 of the US economy, is really powering ahead. Now, so far, so sort of pretty much a standard discussion with respect to equity markets, albeit I'll come on to sort of the outlook for them and maybe a broader view in a minute. What I find interesting has been the performance of commodities and bonds. So if we look at bonds, first of all, that's the purple line. So this is the Lehman, it's not the Lehman US Ag, it's the Bloomberg US Ag. But sort of that's returned nearly 5% so far this year. But certainly, as you can sort of see that the first half of the year is sort of treading water, as it has done for the last couple of years, and then sort of as the expectations over the potential path of Fed policy, yields came down, bonds returned more in the second quarter, in the sort of third quarter of the year, and now we've just in the last few days we've seen that dip down as maybe yields have started rising, given some of the uncertainty around the Fed outlook. Again, nothing that people on the call don't know, but I think what's fascinating about this, when I zoom out in a second, is the outlook for bonds going forward, and we'll cover that more in a second. Now, lastly, on commodities, so commodities is the white line. The Quantix Commodity Index, we prefer to show that because that's how we believe that commodities should be invested in. This is the index that underlies Hedger, and then $100 into Hedger gets invested $100 into this index. So we don't show Hedger performance on here, but it's basically very similar to this before fees and expenses. And what is, I think, constantly surprising to people that I talk to is to say, hey, there's been this tremendous AI-driven trade this year over the last 12 months. You can see that in the NASDAQ performance in the yellow line, and sort of, the S&P 500 heavily tech-heavy, 35% in this concentrated in this handful of stocks. But commodities have done just as well. And I think people are not used to that being the case. People are used to commodities being a lag, and equity markets significantly outperforming it. Now, sort of the majority of the performance within the last 12 months has been from gold, and I'll come on to sort of talk about precious metals more in a second. But I think at a headline level, I think probably coming out of the sort of COVID era, and I know Steve was onto this very quickly in terms of sort of the outlook for inflation and the outlook for commodities. That's done very well, but it's continued to do very well during this environment this year, even as inflation has come down. So even as inflation was up at sort of 7-8%, even as it's come down to sort of the 2s, now it's at 3. Commodities have continued to perform if you're picking the right exposure. Now, if you look at something like the standard commodity index in the space, which is a Bloomberg commodity index, that's up sort of mid double digits, maybe 15%. So again, not as much as we as sort of in our view the right way to invest in commodities, but certainly it is still up. But I think as a as a parting comment on 2025 before we take a zoom out, I think obviously the US political environment has really dominated the early part of the year in equities and in bonds, and then we've sort of seen the AI trade really take over the headlines in the second half of the year. So just maybe to put this year in context, if we sort of zoom out a little bit, and I've sort of used February of 2022 as the starting point for this graph, because that's when Russia invaded Ukraine. So just to sort of give you, like, it's the same 4 lines on the charts. You can see obviously, the Nasdaq has returned nearly 100% over the last 3.5 years. The S&P 500 nearly 70%. The commodities in the QCI, nearly 50%, and then bonds a slightly miserly 3%. And so what I think is interesting is that 2022 period where Russia invaded Ukraine, commodity prices were spiking, and there was that uncertainty with equity markets as they came down. And then you can see at the end of 2022, going into 2023, it sort of takes off in a straight line. And I think obviously a lot has been written about that. And the fact that AI and AI-related stocks have accounted for 75% of the S&P 500's returns over this time period, sort of 80. And Seb Last from JP Morgan wrote a fantastic piece on this. 80% of the profit of the earnings growth and 90% of the capex has gone on AI-related things. And really that line is just a reflection of that. So I think the big question for everybody on this call is obviously investing in US equities. It has been one trade, which is the AI trade for the last 3 years. What's the outlook for that in 2026? And I'll come back to that in a second. Now, what commodities have done, I think, is a little bit different for people. And commodities, again, if we look at it in the version that we do, up 50%. If you look at some of the other more traditional indices, they're up sort of 20-25% over this period. Again, demonstrating why you want to be thoughtful about when you invest in commodities. And in our view, if you pick the right commodity, it changes the discussion around the asset allocation. But I'll come back to that later. I think the biggest takeaway in my mind from this graph is the purple line and bonds. And Steve and I were talking about this before we hit the big red button for the webinar. The bonds have basically done nothing for the last 3.5 years. And in a structurally higher inflationary environment, I think the discussion has to be what you do with your fixed income allocation. And I know Steve was sort of early to that thinking, but I don't think that the 18 trillion in negative yielding debt sort of back 3.5 years ago was one data point. But I think another data point is just if we get structurally higher inflation environment going forward, and I will argue that commodities will be a beneficiary of that because they will be driving some of that inflation over time. The path for bonds, in my mind, and the allocation for bonds is the biggest single question we are talking to our sovereign wealth fund institutional clients all the way down to sort of our individual clients within Hedger. That is the biggest single conversation that we're having with people, is what to do with fixed income and how will commodities sort of react in that type of environment. So with that in mind, to give you a little bit more data, because as Steve kindly has given me the love on the commodity side. I'm the commodities guy, of course I'm going to say this, but just to give you a sense of what actually has driven that the fact that commodities have outperformed US equities so far this year. What's driven that? And that can be summed up in one sentence, and that is precious metals. Gold is up 52%, so that's the right-hand chart on this page. So this just lists the performance of every one of the commodities. Apologies, we've used shorthand for each of the markets, but you can see on the right-hand side at the bottom of that table, precious metals, GC is gold, up 52%, silver up 97%. This was through yesterday, maybe the day before. So really, these have been the things that have exploded this year, and I know sort of people on this call have been onto that trade, and certainly over the last few months have held a decent exposure to precious metals. So what has driven that? And I'm going to try not mention any conspiracy theories, but so the gold trade, first of all, what has driven this? Well, if you look at the gold chart throughout the year, it's really a tale of two stories. The first 3 months, gold went up in a straight line with a Sharpe ratio of sort of 5 or 6. And that was because there was only one participant in the market, and that was central banks buying gold. Why were they doing that? Well, if I come back to my earlier chart on Russia invading Ukraine, and then the US weaponizing the US dollar, as a result of that, yes, the world central banks said, okay, we need to de-dollarize, popularly called the debasement trade now, but certainly for the last few years, they've been adding gold at a pace which is 3 times what it was before that sort of invasion of Ukraine. So central banks around the world, on average, are buying 3 times as much gold now as they were sort of prior to 2022, and that is the debasement trade. Now, what does that actually look like? Well, if you look on an intraday basis, you can sort of see who's buying, because there are some often spikes up in Asian trading hours, for example, when the Asian central banks are buying. Some of our clients are in Asia, and whenever we ask them how much gold they're holding, they always just smile at us. And so we take that to mean whatever we're seeing on the reports is not nearly enough. But ultimately, you've seen the central bank bid in the market, sort of pushing up the price of gold. Now, what has subsequently happened in the sort of middle part of the year is that the speculators got involved. You had hedge funds, you had ETF buyers, and through places like GLD, coming into the market and just buying directional gold exposure. And what that realistically led to is just a lot more volatility before this spike up in September and October. And that volatility just is a function of more short-term traders with weaker hands, to borrow a cryptoism, sort of present in the market. Now, all throughout the whole thing, central banks have continued to buy, Poland being the biggest buyers of gold so far this year. But ultimately, you've had more volatility introduced to the market given sort of the ETF and speculative community crowd. Now, as we stand at the moment, and I'll come back to the gold outlook in a second, silver is an extension of that. It was lagging gold until really the tail end of the summer, and then basically has exploded up over the last couple of months. What is the reason for that? Again, I said I wouldn't mention the conspiracy theories. We don't think they are. We just think that it's a much smaller market. It does have industrial uses, so the AI trade, sort of broadly some of the rally we've seen in industrial metals has also benefited silver. Gold doesn't have any of those industrial uses, but silver does, so like that has come up. Those industrial uses, by the way, used to include photographs back before the iPhone destroyed that industry. Now sort of solar panels and the like are big users of silver. But really, it's just a much smaller market than gold, and so if you get people moving into it in any sort of size, you can see these much bigger moves in a two-way fold. And so silver up 97%. I think it hasn't had a 100% candle for the last 55 or 60 years or something. So this is certainly a significant breakout in precious metals broadly, but particularly in silver. Just to give you a sense of a couple of the other commodities before we come on to the outlook, petroleum, crude oil is down 10% roughly. So the top, on the left-hand chart, the top of that list, CL is the WTI crude oil, so that's US-based crude oil contract. LCO is Brent crude oil, so the international crude oil contract. It's down 10%. That is actually a surprise to people. I'll come on to talk to people, talk why in a second. But the next two, heating oil, gas oil, LGO, and then RBOB, which is gasoline in the States, have either been up or sort of flattish. And that is as a result of these products, which sort of what happened, refined products when you refine crude oil and you get it out the other side, have been kept strong for most of the year because Russia and Ukraine were blowing up each other's refineries. And so the supply in the market was kept tight, historically tight. So the margins that refiners were receiving, and if anybody's invested in refiners, they'll know this, but the refiners, refineries were, the margins they were receiving were at historically strong level. They were basically printing money because the crude oil input price was going down, and yet the output price, the heating oil, the gas oil, and the gasoline was staying higher. Now that's started to come down over the last 4 to 6 weeks with sort of the Russia peace talks, but it's still on an annual basis, they have outperformed crude oil. The last thing I'll mention on this page will be sort of the wheat. Actually, the last thing maybe is just on the industrial. Well, first of all, for any beef eaters out there or steak lovers, I'm sure you've noticed the rise in the price of steak. If not, Donald Trump has been tweeting about it quite a bit, and that may be one thing, one idiosyncratic data point, which is the reason why he's going to pull back some tariffs on sort of the import of cattle. There's been some discussion around sickness in the herd, and the herd in the US is at the smallest levels for 50 years, and there's a number of reasons why that is happening. Live cattle was up 40% for the year a couple of months ago. It's come off a bit, but ultimately it's just symptomatic of commodities going up in price because of supply issues, meeting continued robust demand, and sort of having an impact on people's wallets when they're going out for dinner. So that's sort of a story so far of the commodities world in 2025. If I sort of switch gears and look to 2026, in my view, this is the most important chart that certainly we're keeping an eye out for on a macro level. It's not AI, it's inflation. And we first put this chart together basically about a year and a half ago, when sort of the orange line was sort of just above the 1 of the 1970s, and everybody was sort of saying, hey, are we going to follow this path? I think that is still the big question. I think if obviously people can have views on the incoming Fed chair and who Trump will choose, but ultimately if inflation continues to go back up from here, like the world is stuck between a rock and a hard place, because bond yields will spike, record indebtedness loads are there, and so the proportion that the government spent on interest payments will rise, and that's just a very difficult situation for everybody to be in. So in my view, like, hopefully I am privileged enough to come back and talk to you next year or in a couple of years' time, and I think this chart and how the progression of inflation goes will be very interesting, and frankly impact everybody's portfolios, from commodities through bonds through equities. On an individual commodity basis, the things that we are watching for next year, gold, oil, and some of the industrial metals, I think will be the three big highlights. This is the change in official sector gold holdings. So if anybody tells you that central banks are full on gold, that is wrong. They actually own less ounces now than they did in 1970s. Yes, they've been buying and accumulating a lot over the last sort of 10, 15 years, but in terms of ounces, it's less. Now, the price has obviously gone up significantly over that time period, and so their percentage holdings are sort of have gone up as a percentage of their reserves. But again, gold it's sort of, silver is not a reserve asset, Bitcoin is not a reserve asset, even for the major central banks of the world is not. So for this chart, this is something which just tells us that, hey, there could be a lot more buying by central banks. The flip side, and we do try and be sort of present both sides of the argument. The flip side of the central bank argument, which I don't think many people are talking about, is if gold rises in price significantly, then the proportion of central bank reserves in gold will go up, because the value of their holdings goes up when the price goes up. Many of these central banks do have sort of targets, and if the price rises quickly enough, then they may have to slow down their purchases. Now, a wrinkle or a nuance to that is, if the price rises significantly, it may be because of reasons that will cause those central banks to want to buy more gold. But ultimately, we think the central bank theme is in the market for the next 5 to 10 years. They move in big, slow cycles. They don't really care about day-to-day fluctuations. Like, this is here to stay. So what could be the biggest delta in terms of next year and gold? What could cause gold to go up another 50%? It's this chart. So this is US privately held assets. The right-hand side of this chart is the share of gold within the assets. I know this is not true for most of the people on this call, and credit to Steve and the team for that. But ultimately, the percentage of most US households is about 17 basis points, so 0.17. So less than 0.2% in gold. That's if you're looking at GLD and some of the other ETFs. So it doesn't include physical, which would increase this a bit, but like we think, and Goldman thinks this is broadly true. What I find fascinating is if people were to double that, then the price of gold would go up probably by 25% from here. So the biggest metric that we are watching is if there are significant flows from private households in the US into gold, then you can get a very significant move up in the price of gold as a result of that. And that is, we're talking about sort of less than 1% here. You know, if Morgan Stanley and Mike Wilson made a call, you know, a couple of months ago, talking about moving to 60-20-20 from 60-40, with that last 20 being gold. If people were to follow that advice, then obviously the price would be significantly higher, hundreds of percent higher. But I think this is something we're watching quite closely, and sort of if it gets into the popular zeitgeist, if people are concerned about the US fiscal picture, then and you start seeing gold move up and start seeing flows come into gold, that is a catalyst for more flows in, and the actual percentage holding of gold within people's portfolios overall is very, very low. So that's our outlook for gold, and sort of what we're looking at. It's the single most bullish commodity that we look at when I look at probably 12 months to 24 months and then sort of beyond that. So that's the outlook for gold. The outlook for crude oil is a little different. And again, we're not always bullish on commodities. We like to be transparent and honest. So one of the overriding narratives in the crude oil market this year has been how bearish people have been on crude oil. So crude oil was $55 to $60 a barrel. People have been bearish on it all year because OPEC have been bringing back supply to the market, and like increasing supply. Demand is, broadly speaking, 104 million barrels a day. If OPEC brings back 1 million barrels a day at the margin, yeah, it loosens the balances and should cause the price to go down. The majority of the hedge fund industry has had a very difficult year trading oil because everybody knows those fundamentals, but the price hasn't actually reacted to that. And actually, if anything, the price at the front of the curve, so for delivery in January of next year, has been higher than the price further out of the curve, what we call in backwardation. We've been earning positive roll yield, and actually that was much more pronounced in the middle part of the year. So why is the reason for that? Well, a couple of things. The top chart here on this page shows the crude oil total inventory within the US. And as you can see, the thicker blue line, which sort of bounced a little bit higher at the beginning of the year, and then through the end of the year, like is a sort of the lowest levels we've seen over the last 10 years. What does that mean? Well, there just isn't much oil in Cushing, Texas. Cushing, and there isn't much oil also in the rest of the world. When you look at some of the major Western pricing centers, that is the reason why prices have stayed a little bit higher than otherwise. That is the reason why the curves and structure have stayed strong. So why is that? Well, part of the reason is because people like China have been buying. China's bought 100 million barrels this year to refill their SPR. Everybody was talking about the US refilling the SPR. That's not happened, but China has been doing that this year. So there has been a source of physical demand in the market, which has kept those physical markets tight. The other thing that's happened is that a lot of the excess oil, which is coming to the market, has become into the second chart here, which is global crude oil in transit. So this is oil that's floating in the seas. I would say there's one less given the US takeover of the Venezuelan tanker overnight. But you can see this big spike up on the right-hand side as basically a lot of particularly sanctioned Russian oil has been moved onto boats and is basically just sitting at sea. That oil at some point will come on shore and prices will come down. Where do they come down to? We could see them maybe into the high 40s, but at some point production in the US will come down because it doesn't become economic to pump shale sort of in that high 40s region. So like in short, we think that the price of crude oil is going to go down next year. I could see it going down to the high 40s. What's the upside if there's a global political scare or something like that? But I think also that like we're not big fans of crude oil on that basis. The good news from everybody on this call is, combined with refinery margins compressing, that should mean that gasoline is going to stay around here or even maybe get a little bit cheaper next year. Last but not least, the outlook for industrial metals. So just to dispel a couple of myths, the top chart here has the estimated value of global production 2024, of copper over $200 billion, and of rare earths at $6.5 billion. So to the extent that rare earths are very important within the production of magnets, and there's been a lot of national security discussion around them, and obviously everybody knows that China is the dominant force in both production and also manufacturing. Ultimately, the copper market is much, much bigger and sort of much more determinant of inflation. And so if you're on inflation watch, the copper market and other industrial metals like aluminium, zinc, nickel, and lead are much more important than rare earths. So what is the outlook for copper? Obviously, everybody's been talking about the AI trade and data centers. Well, is that the right thing to be talking about? So if you ask AI, it sort of fixes on a number of about a $2 trillion capex next year in data centers, chips, and everything like that. That's obviously a very large number, and that's the reason why people are looking at the industrial metals and saying the demand for those things are going to go up. And if you want sort of the backup for that, when you look at the age of the grids in Europe, it's actually much higher than the US. In Europe, it's about 55 years on average. In the US, it's about 30 years. But of that, if you look at the spending of that, about 60% is going to go into some of the local, 6% of the grid spending is going to go into like local transmission. Copper is a very intensive commodity for use there. And so we do expect copper demand to increase. The flip side, though, of that is that if you look at the bottom left-hand side, the annual electricity consumption, China is by far the biggest consumer of electricity in the world, and we are not seeing the demand from China at the moment. They consume 55% of the world's copper. We're not seeing the demand coming out of there at the moment, and we haven't for some time. So we are bullish on copper generally for this theme, but I think just to everybody on this call should know, this isn't something where, in our view, copper is going to go up 50% over the next 3 to 6 months because of data center usage. One reason why it might do is because if the US imposes tariffs again, and obviously we saw that, and there was this sort of imposition of potential tariffs. US-based copper went up significantly. London-based copper stayed the same, so this ARB opened up. Then when the tariffs potentially came off in July, like you saw the reversal of that. But there is still a potential for tariffs to get put in place on US-based copper. So anybody who's trading physical copper is trying to take metal out of the rest of the world and move it to the US in anticipation of that, because the ARB is there, because they can sell that copper for much more in the US than they can in the rest of the world. But again, that is a supply story and a tariff story. That is not an AI data center story. Now, the way that could change is the bottom right-hand side, which is installed capacity. And part of the reason why China is such a big consumer of electricity is because over the last 15 years, they've spent a huge amount building out nuclear power stations, gas power stations, and also their grid, much more so than the US or Europe. Obviously, we think that the US and Europe need to play catch up, but on a macro basis, this will be a fascinating thing to watch and observe, because like with commodities, physical logistics matter within these markets. The parting shot I'll leave on industrial metals is defense spending. We recently wrote a paper that estimated, so everybody's talking about the AI trade, $2 billion of capex for next year. If the rest of the world get to 4% of GDP spending, so below NATO's 5% target, if the rest of the world got to 4%, that's an extra $1.7 trillion a year they'll be spending on defense. And a lot of that flows through to the raw metals you need to build the ships, tanks, the drones, the bullets, and everything like that. And that could be an additional source of demand as well. So overall, industrial metals, we are generally positive. One caveat with sort of the demand from China, we're not necessarily being as huge at the moment, and sort of this AI trade is important and sort of grabbing the headlines, but the rearmament trade is also something which is there to be watched. So and then I'll pause and Steve, hand back to you. But I think overall, how do we view next year? We view there as being positive catalysts, certainly in the metals, precious metals, the continued debasement, and also in the industrial metals as well. Something like petroleum and crude oil has a bit of an idiosyncratic story, but we're less positive on that. But overall, we think the commodity complex will continue to do well. And if it does, or if there is a political shock, geopolitical shock, that has the potential to push inflation back up, and that chart that I showed earlier, inflation 70s versus now, is something that we'll be watching very closely. So Steve, sorry, I ran a little bit over, but to you.
No, absolutely. It that worked out perfectly, Dan. So you know, from our perspective, and our clients know this from my client letters, you know, one of the things that we're most concerned about, both near term and long term, are the real returns on their portfolios as opposed to the nominal returns, which is why Dan and I, speaking prior to starting the webinar, were effectively, you know, preaching to the choir back and forth to each other on this issue. And Dan, I want to thank you. I mean, you did an absolutely incredible job just laying out all the different pieces and how everything intertwined. I you know, I think, you know, hats off. I think you did a fantastic job just weaving everything together in terms of both you know, where the commodities are and how they impact everyone's daily life. And I appreciate that. Let me just open it up in terms of any questions that anyone wants to send through on the chat here, and we can address those. And you covered everything from my perspective, so I had no you know, questions left over, Dan. So I'm going to leave it to the audience because you were very thorough.
Pleasure. Well, in that case, Steve, if I will just make one further point, which is this is the long-term performance of commodities when we view it in, you know, having been done in our view the right way, but what we do, versus even US equities and or bonds. You know, I think the conversations we are having with clients across the globe at the moment are, you know, the commodity allocations in the mid single digits, the high single digits, which I know is sort of the range for you, Steve. You know, it is significant, and I think people are tentatively starting to talk about, well, you know, should that be higher? Should that, and I think part of that is the outlook that people have for, which we've just discussed. But part of it is also everybody's getting more comfortable, frankly, with having a tool at your disposal like Hedger or like this framework, where actually over the long term you can have the inflation protection, the diversification, but also actually still generate returns. Now, obviously, yeah, if we look at this chart, which is the allocations over time, you know, what will drive Hedger's performance next year? It will continue probably to be the precious metal sector. That's the biggest sector, at about 35% at the moment. The petroleum sector, obviously at the bottom, is also still a chunky allocation because it is the highest inflation sensitivity of all of the commodities. But I would expect that if we're right in terms of, and by the way, even though prices have come down this year, you've gotten positive roll yield from the structure, so actually returns overall have been okay. I would expect maybe, you know, that petroleum to come down if we start seeing, you know, some of the weakness within the crude oil space. That the index rebalances every quarter. This isn't something where we apply discretionary views, so that will take a while. But I think when I look at the allocations here, what my expectations for next year are is sort of continued, you know, large positions in gold, and we might see that allocation within petroleum coming down, and some of the other commodities, the other sectors, sort of increasing in size.
Great. Hey, Dan, we have our first question from the audience. So I'll read it. It's not terribly long. So the Fed yesterday implied only one cut for 2026 and I'm going to put in parentheses in their SCP, but markets seem to be pricing in something closer to 2 or 3 cuts. Where do you see the path for rates going in 26? And is there a specific catalyst you're looking at to create the path for the additional cuts?
So with the caveat that I'm a commodities guy, not a rate guy, but I think with the 2 cuts, I don't know if the market is sniffing out the political influence on of a new Fed chair, and which I think that some of the details that have come out over the last 24 hours, the 6 people that dissented, I think that's just a very messy discussion. It's not a straightforward one, but I think the market maybe sort of sniffing that out rather than just reacting purely on sort of the economic data, which obviously the Fed says is data dependent. So I think we don't have a strong view internally is the short answer of whether it's 1 or 2. I think some of the risks to the job market if AI adoption continues are real. I think the societal impact of that broadly has not been discussed enough. I think in terms of the financial impact of that, I think as we discussed earlier, if the US equity markets are so tied up in the AI trade, I think you're effectively exposed to a single factor, and our partners at Harbour have done a fantastic job of expanding on that and looking at sort of that factor in international stocks and across other parts of the portfolio, not just US equities. So in short, we're somewhere probably 1 to 2 makes sense. I don't think we have a strong view outside of those 2 things. I will say that if you get the type of rate cut matters. If you get a dovish Fed chair from a political perspective that is not aligned with the data, in my view, like there's one asset that you want to own, and that's gold. Silver obviously is much more volatile. It's a smaller market, as we discussed. So it's just a bit of a different animal. But if there's one asset that you want to own, it's definitely not treasuries. It's going to be gold. And again, like that potential trade in from the US household and then the global household into the gold market, like that we're in the very early innings of what that could be. And then that's the sort of thing where once the train starts rolling, I think it'll be pretty difficult to stop. So ultimately, as I sort of said earlier, this is, in my view, the most important chart. And if inflation continues to pick up, then sort of you either have the Fed raising rates, which is bad for equities and bonds. That the impact on commodities will be bad if it causes a recession. Or the Fed doesn't raise rates if inflation continues to go up, and actually then you start getting more questions around debasement and the US fiscal picture, and that, like, you have to own gold in our view for that scenario. Now, if inflation moderates, then I think there's a little bit more room for discussions around sort of portfolio allocations, but certainly if we remain in this type of environment, commodities, in my view, are pretty attractive.
I'm agreeing with everything that Dan said. The only thing I'll add, if you look at the SEP, the Summary of Economic Projections that the Fed put out yesterday, they did bring down their estimate of inflation by about 1/4 point. So that, I think, was their cover for the 25 basis point reduction that they see in 2026. I'm firmly of the belief that we're not going to ever get back to 2 in terms of inflation, and the Fed should count their stars very, very lucky that inflation expectations have not unanchored at this point. I mean, I think the Fed is at a tacit admission that 3 is the new 2, from a market's perspective. So I can't see anything more than that one from that perspective, other than the political aspect of it. I'm struggling to find a path in which we get that 2 or 3 beyond the political and just the turmoil in terms of changing chairman and things like that. So that's just this observer's 2 cents from that perspective. I don't see any other questions at the moment. I guess last call, since we're running up closer to the top of the hour here. If we don't have any questions, I guess I'll give everyone 10 minutes back of their day. Going once, going twice, and there we go. Dan, thank you very much. This has been a excellent and spirited discussion, as I had hoped. And I want to thank everyone for attending our year-end review and outlook, and wishing everyone happy and healthy holidays coming up here. Again, thank you guys very much.
Thanks, Steve. Thanks, everyone.